the next item is the operating leverage, right. Now, operating leverage is a phenomena in which the presence of fixed cost in the cost structure increases the profitability, right. The leverage, this word comes from lever, right. So, in as we discussed earlier that the cost structure can be fundamentally divided into two parts. One is fixed cost, the other one is the variable cost. Okay. And when we are doing this, the presence of fixed cost in the cost structure, it can change the increase the profitability disproportionately, right, because of presence of fixed cost. So, we will discuss about the operating leverage. So, operating leverage is basically a phenomena in which due to the presence of fixed cost in the cost structure, the return to the capital invested that increases or decreases, that changes disproportionately. So, we will this operating leverage, the leverage is a word which came from the word lever. So, this operating leverage, it shows that because of presence of fixed cost in the cost structure, how much the profitability is changing. So, we can look at it. So, operating leverage describes the effects that fixed costs have on changes in operating income as changes occurs in units sold. So, organizations with a high proportion of fixed costs have high operating leverage. So, if the fixed cost proportion is high in the cost structure, the operating leverage will also be high. So, actually what happens because of fixed cost, as we discussed earlier, that the per unit fixed cost decreases if the production goes up. So, because when the production goes up, right, the per unit fixed cost it got reduced, and because of that the profitability increases manifold. So, this phenomena is called the operating leverage. So, one example. So, degree of operating leverage we can calculate by dividing the contribution margin with the operating income. So, what is the degree of operating leverage of the toy shop, the example which we were discussing, at the 3,500 sales level under both arrangements? So, existing arrangement is 3,400 and original contribution, if you remember, it is 28 rupees. So, 3,500 into rupees 28, rupees 98,000. So, that is my contribution margin. So, minus fixed cost, the original fixed cost was 84,000. So, 98,000 contribution margin and 84,000 fixed cost is 14,000 operating income. So, 98,000 divided by rupees 14,000, that is my operating leverage, right, that is 7.0 is my operating leverage. Under the new arrangement, 3,500 into rupees 35, that is 1,22,500 is the contribution margin. So, 1,22,500 contribution margin minus 1,14,000 fixed cost. So, my profit is 8,500. So, my operating leverage is now 1,22,500 divided by rupees 8,500, that is 14.4. The degree of operating leverage at a given level of sales helps managers calculate the effect of fluctuations in sales on operating income. Now, the learning objective 7, apply CVP analysis to a company producing different products. So, when a company is producing different products, how the CVP analysis can be used. So, effects of sales mix on income. So, toy shop example again. So, management expects to sell 2 footballs at rupees 20 each for each unit of toy it sells. This will not require any additional fixed cost. So, now you see, earlier the company was using a single product, that is the toy. Now it is another product he is introducing, that is the football, and it is expecting that 2 footballs priced at rupees 20 will be sold for each unit of toy. Contribution margin per football is 20 rupees minus 9 rupees, that is the variable cost, that is rupees 11. What is the contribution margin on the mix? So, INR 28 we calculated earlier plus 2 into rupees 11 is equal to rupees 50. So, on sales mix 84,000 it remains the fixed cost divided by rupees 50, that is contribution, it is 1680 packages. So, 1 toy plus 2 football, so that is 1 package. So, it is expecting it needs to sell 1680 packages to become break even. So, how many units? 1680 into 2, that is 360 footballs. 1680 into 1, that is 1600 units of toy. So, total units is 5040. So, effects of sales mix on income. So, now what is the break even? If when we are taking the sales mix, what would be the break even? So, 3360 footballs into rupees 20 is 67,200, and 1680 units of toy into rupees 70, that is 1,17,600. So, total is 1,84,800. So, effects of sales mix on income. What is the weighted average budgeted contribution margin? So, we can calculate it. The toy 1 into rupees 28 plus football 2 into rupees 11. So, it is rupees 50 divided by 3, that is rupees 16.667. So, that is the weighted average contribution. The break even point for the two products will be rupees 84,000 divided by rupees 16.667, that is 5040 units. So, 5040 into 1 by 3, that is 1680 units of toy, and 5040 into 2 by 3, that is 3360 footballs. So, that need to do. So, if sales mix can be stated in sales in rupees. So, if we do that, then it will look like this, that is toy. For toy, you can see the sale price is 70, the football, the sale price is rupees 40, variable cost is 42 and 18 respectively. So, contribution is 28 and 22. So, contribution margin ratio is 40% and 55%. Assume the sales mix in INR is 63.6% toy and 36.4% football. So, weighted contribution would be 40% into 63.6%, that is 25.44% toy, and 55% into 36.4%, that is 20.02% football. So, weighted average is 45.46%. Break even sales is rupees 84,000, which is the fixed cost, divided by 45.46%, that is 1,84,778. And we can see like this, we can if we break in toy and football, it is INR 1,84,778 into 63.6% is equal to 1,17,519 toy sales, and 1,84,778 into 36.4%, that is INR 67,259 football sales. Thank you.